Hi, my name is Paula Swain. I'm a financial planner with the Financial Center for Women. And today with me, I have Rachelle Syron, who's a CPA. Rachelle, why don't you take a second to introduce yourself?
Hi, my name is Rachelle Syron. I'm with Grant Millman and Johnson, a CPA firm in Novi, Michigan, and I'm a shareholder and I specialize in tax planning.
Perfect. So today we're going to talk about, let's start it this way, I guess. So when I'm planning for someone's retirement, I would like to have different buckets of money to pull from. So why don't you talk about what those different buckets of money are?
You could have cash, a retirement account, or a brokerage account.
So cash, we all know about cash. Cash is king. So if I have a brokerage account, what does that mean? What's in a brokerage account?
Basically, bonds, stocks, or mutual funds.
And then you talked about qualified assets. What are qualified assets?
An example is a 401k plan.
Okay. So I know this, but most people may not know is that all of those different in different buckets of money are taxed differently.
Mm-hmm.
So let's just start off real quickly. Like a Roth IRA, how is that taxed?
You're putting the money in after tax dollars, so you're already paying your tax up front.
Okay, so when I withdraw from a Roth IRA, I have no tax implications, correct?
Correct.
Okay.
Correct.
So now I've saved in a 401k or an IRA. So how is that taxed?
So if your employer has a 401k plan, you're taking your paycheck and you're putting whatever percentage you would like into that plan, and that's pre-tax. So you're not paying tax on those wages because you're putting it in a retirement account. And then when you withdraw it, then you're taxed.
Okay, so a Roth IRA, when I withdraw it, it's tax-free.
Mm-hmm.
A 401k or an IRA, it's taxable, 100%
Right.
taxable. Okay.
Right.
So a brokerage account, which is totally different. So if I own a stock, and let's say I bought that stock at $100, and then I sold it, 2 years later for $150, how is that taxed?
So it's the difference between the amount, what you bought it for and what you sold it. So the $50 is taxed. And since you noted 2 years, that's a long term. So that's taxed at capital gain rates, could be anywhere from 0% to 20%, depending on your adjusted gross income.
Correct. Okay. So just that $50 is considered the capital gain. So that's
Right,
the portion that would be taxed.
Exactly, because the $100 is considered your basis.
Okay. So that's
So
the
you're
money
not
I started
taxed
with.
on the money you bought it for.
Correct. Okay. So now I'm going into retirement, and let's say I need a $50,000 income. I've got $20,000 coming in from Social Security, and I needed $30,000. So what's the advantage to having those different buckets of money?
How they're taxed. So if you had a Roth and you took some out of that, you would still have the money you need, but you wouldn't be taxed on it. If you've got just cash, anything you withdraw from the bank, of course, is not taxed. And then, depending on your bracket is how you're going to withdraw from your IRA or your 401k, because that's going to be taxed at your ordinary rate. So if you're in the highest tax bracket at 37%, that's what you would be taxed at. If you're in a low tax bracket, maybe 15%, then that's the rate on that.
Okay, so what you're saying is that I need money, I'm pulling it out of my buckets of money, and if I'm pulling out a Roth, I'm not going to pay taxes on that. So I could pull out as much as I needed, but I'm not going to have to pay any taxes.
Mm-hmm.
Or if I don't have a Roth and I'm going to just pull out of my 401k or IRA, if I needed, $30,000, that $30,000 is going to be 100% taxable.
Mm-hmm.
And then if I sold stock and I ended up with $30,000 of capital gain, that then would be taxable depending on what my income bracket is, which could be from 0 to 20%. Do I have that right?
Right.
Okay, perfect. So I think kind of what we're saying is that when you go into retirement, it's nice to be able to pull from different buckets of money so that we can manage your tax bracket. ultimately trying to keep you in the lower tax bracket.
Right.
Okay.
There's another glitch in there too.
Okay.
When people go to sell the stock, depending on, there is the capital gain rate, but also if you're in a very high income bracket and it's over 200,000, you're also paying a 3.8% net investment tax. So people forget about that, and they need to add that into their calculations as well. So it's called additional Medicare tax, and it's a 3.8% investment tax.
Okay. Okay. So that's people in the really high tax bracket.
Yes.
Okay. What is that is that on all their income or just on
anything over 200,000? So if you once you start over 200,000, so let's say you're at 250, it's only the difference. It's the 50,000 would be taxed at 3.8.
Good to know. I mean, so if you're, it makes a case for any of that makes a case for having different types of assets to pull from at retirement, because if you are at the 200,000 and if you sell more stock, you're going to pay that 3.8 or your additional income. But if you pull from a Roth, then you don't have to worry about that 3.8%.
Right.
And it works just as well, even if you don't have a $200,000 income and you're only living on 50 or 60, we can manage tax brackets to ultimately, pay the lowest tax possible.
Exactly.
Okay. Anything else you'd like to say, Rachelle?
Just make sure you have a budget. Nowadays, I think people are not saving enough, and still put into your retirement, but also have a savings that don't have all your money in one basket. Don't put it all in the 401k or have it all in a brokerage account where it's generating income. But if you need it, you can't have access unless, you sell stock and then have to pay the tax on it. You have to have some in savings, just the plain savings, and it doesn't generate much income. The interest rates are low, but at least you can have access to it, and don't borrow from your 401k. I see so many clients, they have 401k loans, and you're missing out on that income generation through the years. So.
Yeah, I agree with all of that 100%. I really love it when I see that people have a really nice size emergency account. And then I think even with COVID, it's been something that's been really important because, job security has been a challenge for a lot. So, making sure you have that emergency account. I know liquidity, which when I use the word liquidity, is being able to get your hands on your money quickly.
Yes.
Is really kind of a gift when you're in a situation where you need money. So I agree. Save in your emergency account, save in a brokerage, and save in a Roth IRA, and save in a 401k if you can do all of those. But the key is just to save. I want to thank Rachelle for being with me today. Feel free to give her any call if you have any tax questions, and give me a call if you need anything. Thanks for coming in today, Rachelle.
You're welcome.